Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Hope I am audible to you. Let me display the PowerPoint presentation. Hi, Maud. Thanks for confirming that you are able to hear me. Okay, I'm just displaying the PowerPoint presentation. Tracking the forex market together, part 2. I gave the part 1 between 10 and 10:45 GMT today. And part 2 is between 14 and 14:45 GMT. So it is a very simple market tracking technique and effective trading strategy in order to earn consistently from that of the market. For that, what is the tool we use? We use the live market quote page as the tool and try to see the price action and also track the market using that of the session timings followed by that of the players. So there are 3 different sessions in a given day according to the players, and Japanese session, or you can call it a session 1, and it is between 0030 to 7 GMT. Then 7:30 to 13 GMT is the European session. During the European session, I gave the part 1 during mid-European session, and I also placed some orders. And I also converted the limit orders into positions. I'll show the fate of such orders. And I also gave the information that they are trying to do the intentional move on the upside. So I will try to see whether it is continuing as expected by us. Then afterwards you come across the gap time between 13 and 13:30 GMT. The gap time moves a false move in which the players try to make the stop and moves, and then US session starts from 13:30 GMT and we are at 14 GMT now, 30 minutes past the start of the US session. So how the basic trading strategy has to be done. Now we note down the initial low and the high set in the live market set around 3:30 GMT using the live market quote page, and note down in the 4 majors and 2 commodity pairs around 3:30 GMT during the Japanese session. So I'll just focus the camera and briefly show you what were their levels. Now Euro formed the high 1.2266 around 3:30 GMT. Still it is holding above 1.2266. Now you can see that GBP was having the low initial high was 1.5531, and still currently it is trading around 1.5566. It is still above that. And in the case of USD yen, as I explained, 79.25 was the initial low. They came down to 79.14 during European session. They came down to 79.22 and then went up to 79.27, and now you find in the live market quote page 79.14 is the low and it has come to 79.45. As I was explaining during that of the European session, that they are making the negative net change in the case of yen and positive net change in the case of euro and GBP. Now they are showing positive net change in the case of USD yen also. So as envisaged, they are making the moves. That is the only way they make the moves. So they don't change. So we can easily read their intentions. And in the case of CHF, 0.9790 was the initial low, and they are still holding below 9790. And the new low they formed during European session, 9768. That also they are not breached. So very sluggish move is happening between that of the initial low and the new low in the case of USD CHF. And Canadian dollar, again, the initial low was 1.0211 and they formed the new low 1.0173 as the new low, and still holding above that new low and not breaching it further down. It is again a sluggish downward move. And in the case of Australian dollar, the initial high was 1.0213 and they formed the new high 1.0281, currently holding around 1.0267. So if you see what I explained during that of the European session, initially they wanted to make a downward move in the case of yen crosses yesterday and early part of today, and now they wanted to gain the levels in the case of yen crosses. Further, they gained the levels in the case of yen and gone above that of the high. 79.44 was the initial high, and they have gone up to 79.49 and currently trading around 79.48. So because 18 GMT there is an FOMC meeting minutes, till such time they are expected to handle the crosses. So for that, holding high euro and GBP, they are gaining the levels in the case of USD yen in order to squeeze the short sellers to go for short covering in the case of yen crosses. And they wanted to keep flat in the case of USD CHF and Canadian dollar, Australian dollar, GBP and euro. They wanted to gain further upward during this particular time, as they are shown the intentional move holding above that of the initial high for more than 2 hours. That means for 2 sessions and part of the third session, they intend to gain the levels. So they started going above this particular level during that of the European session. So European and US session, they will continue to trade above this and continue to breach the high and slowly take it up during the close of the day. And tomorrow they are expected to open high and make an upward move, and afterwards try to make a downward move, because the intentional move will be for the 2 sessions and the start of the third session, and then they will try to reverse either in the form of a swing or in the form of an extended move or a false move or a stopper. That we have to read it for tomorrow. So this is how, if you try to track the moves, it is easy for us to understand what they intend to do. Then the trading decisions becomes very easy for us. I'll just now focus the camera over that of the live market quote page, so that we'll be able to understand that how slowly they are firming up. In the case of euro, 22.80 is the current level. 31 pips positive net change is seen. USD yen is showing positive net change after making a downward stop. They have made the upward move above that of the initial high, 79.44. So in what way the economic news has induced the market to make moves like this? Euro and GBP are making the USD weakening move, and USD yen is making the USD gaining move. This is how they make such moves. And in the case of USD CHF, they are making a small dip, now coming closer to that of the low. And in the case of Australian dollar, again they have started gaining the levels. So in the process, you find the yen crosses which were in the negative net change earlier, slowly they are coming to that of the positive net change. And you know that in the case of yen crosses, they do the similar moves for 2 days. So they make downward move for 2 days, then hold, then make upward move for 2 days. If you understand the rhythm, then you will be able to easily trade in such pairs. So I'll go back to that of the PowerPoint presentation. So after noting down the initial lows and the highs, we also note the net changes in the market from that of the current level, which is actually calculated from that of yesterday US session close. Then watch whether the market is near that of the low or near that of the high. If it is in the middle level, we simply relax. That is with regard to initial low and the initial high. And currently, they are holding above that of the initial high in the case of euro, GBP and Australian dollar. So that means we can only do a technical trade of buy above that of the initial high and try to book profit during further rise during the day. And we can even wait for tomorrow start of the Japanese session and try to book profit in order to maximize the profit. So blindly we cannot hold it. Instead we can use a trailing stop in profit making position. Thereby the trailing stop will go up quickly when they quickly gain the levels tomorrow in order to hit the stops of the short sellers, and our trailing stop will maximize the profit. Then let them drop. We will re-enter again after that drop. So this is how we have to perceive the market and identify the type of moves what they are doing it. Also we have to understand, if you are trading in the case of majors, they will be doing the active moves in the case of majors during the early and the late sessions of each of the sessions. That is 1 hour and 30 minutes from the start of the session. Now US session, 13:30 GMT, the US session started. Up to 15 GMT, it will be early session. Then the 20:30 GMT, the late session gets over. So 1.5 hours from there, it will be from 19 to 20:30 GMT will be the late session. That is why you come across market remains subdued during the mid sessions. They make only swings between the high and the lows in different pairs, and sometimes you may come across euro gaining, GBP dropping, and GBP gaining, euro dropping, that sort of swings, mainly to handle the crosses during mid sessions. Then the active moves during that of the late sessions, they are expected to make, and you know that today FOMC meeting minutes are expected around 18 GMT, and they will use it as a trigger. I'm giving the forecast that they will make an upward move. How? Because they have already done the intentional move of gaining for more than 2 sessions and holding above that of the initial high, and using that as a trigger, they will make further rise. I do not know the outcome of FOMC, what they are going to display or what they are going to announce, but I can read the intentions of players that they may make a small volatile move to create uncertainty, but they intend to make further rise as long as they are holding above that of the initial high. Now, we have to identify the type of moves, and that is very important in order to understand what sort of trades we can do it, how long we can hold the trade. So normally they make the moves less than 30 minutes during start of the session, during early session and the late sessions, and also during the gap times. Those moves are stop and false move. Stop is the one they go up to the of the high, breach the high by 10 to 15 pips or 25 pips and come down below that of the initial low in less than 30 minutes. Similarly, below that of the initial low and go still lower and come above that of the initial low in less than 30 minutes. That is stoppant. So if they want to rise during a session, during the early session they make a downward stoppant and then start making the rise, so that those who are holding the long positions will be stopped out when they rise, and they will get the least selling pressure of the traders. So they see that the traders don't don't book profit. So that we have to understand, and during such downward stop, and if you try to take a position, they can't make further stop and for us. There comes our smartness. Then false move is the one they come up to that of the low and then go up and breach the high and stay above and continue to rise. And that they do it to avoid giving profit booking opportunity to that of the short sellers. So they try to dip when the traders are relatively long and short. They try to dip as if the market is going to fall. Now they have done it around 12:30 GMT today, and then those who are holding long position out of fear will liquidate and accept minimal profit. Then after the data release, they will continue to rise the market irrespective of the data. And so when they just gain the levels, then the short sellers alone will be there. The long holders would have already seen the profit, probably repent that I just closed the position at an early stage. So you have to read their intentions, then we will not do such trades. Then you come across the moves above that of 30 minutes. That means they stay above that of the initial high or stay below that of the initial low for more than 30 minutes and up to 2 hours. That is an extended move. These extended moves are quick moves. So they quickly go above that of the high and stay there and continue to cut the high in just for 2 hours. The last 30 minutes they stop cutting the high and come below that of the initial high afterwards. That is an extended move. And these extended moves are very quick moves. Sometimes you find that they make such moves in about 1.5 to 2 hours. They just continue to gain the levels and see that they gain about 150 to 200 pips or 100 pips. So such quick moves are mainly done in order to gain level with the least buying, or in order to drop the levels with the least selling. So they do the circular trades and continuously drop in a fraction of a second or in just 30 minutes time frame and things like that. So which we call it as a knee-jerk reactions. And why they do it and that when the data is released and things like that, they purposely do it without taking much of a sell positions. They drop it. Afterwards, they hold near the low for about 1 day, 1.5 days, and things like that. And the traders lose the patience when the market is not moving upward and liquidate the long position. Then they continue to gain the levels. So patience is a virtue in the market. And whenever they make the extended move or a quick move, understand it is a false move. They quickly gain the levels. You know that from 1.2450, euro went up to 1.27 in a matter of one session last week. And why they had done it? In order to gain the levels to book profit, and subsequently they made the drop. Whereas a slow move like this today, slowly they are gaining the levels. Every pip by pip move is there with the swings and things like that. This is mainly an intentional move. That means they wanted to gain the levels, and during the gaining process they wanted to buy every sell there. Why they have to buy every sell? So that those who are short sold will come for the short covering later on. So they cannot continuously trap the long holders, then nobody will turn long in the market. They have to alternately trap the short sellers and the long holders in the market. Only then they consistently make profit. Now, I will go back to that of the European session trade. What happened to the positions and where they are? Because I wanted to explain the trading strategy, basically identifying the type of moves. So now you find that intentional move is the one wherein they breach the high and stay above for more than 2 hours. They continue to stay and the net change is in positive territory. So if they make a small dip, if it become bearish and think that it may reverse, that means you are not in a position to read their intentions. And if you read their intentions very clearly based on the type of moves they make it, this is not the first time I'm telling. For the past 12 years, I've been making observations. They don't make any change with regard to the type of moves. So you can understand that is the only methodology of trapping the traders by that of the players. So I kept the limit order at 1.2273 when euro was around 1.2283 during that of the European session. They filled and came down little bit to 1.2256 and 54, etc. And subsequently I kept the low, the entry stop or the hedging order 1.2243, and still you can see in the live market quote page 1.2247 is the low, so they are not filled it. Now currently it is trading around 1.2279. I could have booked a profit when they firmed up to that of 83, just a matter of 10 pips. Since I said that it is an intentional move, we can wait for another session and try to maximize the profit during that session. So once we read their intentions very clearly, then once the position makes about 15 to 20 pips profit, you can keep stop at entry and continue to wait and maximize the profit. So if you understand them well, you will not be booking profit in a hurry. Small dips you will not consider as a reversal. So that sort of understanding is very important in the market so that you will get rid of the market fear. Then in the case of GBP, I kept a limit order 55.43. They are not filling it. So I just modified and took a buy position at 1.5557. So instead, accordingly, 30 pips below, I kept the hedging order. Then similarly, in the case of Aussie, I kept a buy order at 1.0232 and I took a buy around 1.0252 when they came down. They came down up to 50 and went up. So I was able to take it around 1.0252, modified from 32, just about 15 to 20 pips or 5 pips. You can modify and take it, not an extreme level of 30, 40 pips. Then accordingly keep the hedging order. Still the hedging order is working and their positions of making nominal profit. Once they make about 15 to 20 pips profit, I'll keep stop at entry and try to maximize the profit. Since FOMC is there today by 18 GMT and they are expected to gain the levels up to the early session and also the mid sessions. So mid-session is up to 19 GMT. So 18 GMT is the announcement time. So around 16:30 GMT or 17 GMT, they will just pick it out or make an upward stop and then come down little bit before the announcement as a false move. Then after the announcement, they are expected to rise. So as a smart trader, what I will do when I am able to read that they have to make a false move before the data release. And so false move, they have to quickly gain and hit the stops above that of the high. So they earn from that of the short sellers. Then afterwards make a quick drop so that if somebody continues to hold the long, they will just liquidate the long. And then after the data release, they are expected to make the rise. So a false move will indicate what they intend to do after the data release. If they drop before the data release, that means they wanted to rise after the data release. The drop might be still a very less drop, like 10 to 15 pips or 20 pips. After making a stop and above that of 1.2296, they are expected to make a dip and then continue to rise. So what I can do is around 16:30, 17 GMT, when they just make an upward stop and see that it is only a stop and they are not gaining further up above that of the initial high and recent high and come below that of the recent high. In less than 30 minutes, I'll just close it using a trailing stop, all the positions. And when they make a dip before the data release around 18 GMT, around 17:55 to 17:58 GMT, I'll trick the buy positions when they are making a false dip before the data release. And then they are expected to make the rise and I will book profit again. And here, when I try to re-enter into the market, still I will keep 30 pips hedging order because I'm taking a risk of 30 pips at any given time, irrespective of a very strong data release like a non-farm payroll or FOMC meeting. I'm not worried because I'm just taking a chance. I know very well during the data release, they will make very good volatile moves. Only if they make very good volatile moves, I'll be able to capture about 50 to 60 pips profit in a matter of about 10 to 15 minutes. After the volatility is settled, if I try to take the positions, I have to wait for several hours to book profit. So I wanted to capture that volatility. I'm not afraid of the volatility because I know their intentions. I'm able to read their intentions. They make a false move before the data release. So they made a small dip before that of the 12:30 GMT data release, that is trade deficit. They made a dip. So we know very well after that data release, they are expected to gain the levels. If the data released around 12:30 is, say for example, USD negative, then they will say it is USD weakening, so they will gain the levels. If the data comes in positive zone, then they will say it is risk appetite, so we are rising. So because they had just made the dip before the data, so they make their moves according to their wish, according to the pending positions of the trader, and give different interpretations to the data release and make different comments later on in order to just convince the traders why it has gone up or why it has dropped. They wanted to give some excuses. So these are all the positions I am still holding, and once the positions make 15 to 20 pips profit, I'll keep stop at entry. Still, the hedging orders are there to limit the risk. To that of the market reading, I explained the 4 different types of moves. The stop and the false move with regard to time frame 30 minutes, and extended move 30 minutes to 2 hours. And if they hold above the initial high or hold below the initial low for more than 2 hours, you can take a buy above that of the initial high and try to book profit during further rise, or sell below that of the initial low and try to book profit during the continuous drop, so that you will have a definite understanding based on the identification of the type of moves. Now, in US platform, the hedging facility is not available, but some of the traders might be having the accounts in some other platforms, country platform, there the hedging facility may be available. So if you use hedging, you will be having suppose you are taking a buy position, you will have a buy as well as a sell position. Both the positions will be there in your platform in the same currency, so that it is the first step to prevent the erosion of the usable margin. We can use the stop, but the stop will close the position. Only if we have the positions, we will be able to trade. Otherwise, you have to re-enter into the market. If you have a buy position as well as a sell position, and 30 pips is blocked, it is a higher level buy and lower level sell. We can just reverse it. When they make a big volatile move on the downside, we can book profit, and when they make an upside move, we can book profit on the sell side. Otherwise, after hitting our hedging order, if they continue to gain, doesn't matter, we can book loss in sell position of 60 pips or 40 pips or whatever it is, and maximize the profit on the buy side. Suppose you have booked loss in sell side about 60 pips. On the buy side, once the market starts showing the profit, if you make profit more than 60 pips, then you will have a net profit for that particular trade. So you have to understand the mathematical principles behind the trading, that you should not have the mindset, I should never book loss in any position, and then it inhibits you to accept loss during trading. So if you have just missed that opportunity of closing the hedging at stop at entry, then you can always try to close it with a loss even of 100 pips loss, and if you earn 140 pips on the buy side, you will still have 40 pips profit in that particular trade. So that you should be able to perceive and trade, so that nobody can create fear for you. And even if it is hedged, when you have gone out and the position is hedged, you come back and see that market has made an upward spike and things like that, still you need not worry about it. You will not feel that you are struck. You will try to handle the buy side separately. For example, when they are making continuous rise of 200 pips, like the previous week, then you can book profit on the buy side and keep hedging order above that as another hedging order buy in order to limit the risk for the short side. Then they start dropping the market, can lower the hedging order downward and close it with a minimal loss, or close it with a profit also on the sell side. So that sort of great opportunities you will be able to perceive if you use the hedging. So with regard to the entry and the exit, normally after 30 minutes from the start of the session, you have to find out what sort of moves they have done it during the US session, whether it is an extended upward move or an intentional move, and whether the market is near the low or near the high or above the high or below the low. Today, current condition, you find that Euro and GBP are making intentional move because still they are holding above that of the initial high. Then what you can do, you can only do a technical trade, not a swing trade of sell near the high and buy near that low. You can only do a technical trade, buy above that of the initial high and book profit during further rise. As I explained that during the data release time, they will try to make some volatile moves, and before that they will try to hit the stops because they are making a continuous gain slowly. They will make a quick rise and hit the stops above that of 1.23 and then come down, and immediately people will think that FOMC is going to trigger the market to come down drastically. Then after that FOMC minutes, they will give different type of interpretation and say risk appetite or whatever it is and continue to gain Euro and GBP. Then they will say non-farm payroll created risk aversion, FOMC created risk appetite. In a matter of 2 days, the economy has undergone a drastic change. So we have to accept all those changes. Then exit. When they continue to gain the levels, and you have to see that new level, they are not breaching it for more than 30 minutes, and then try to book profit. Now they have done the intentional move. We can wait up to the start of the third sessions and book profit. Otherwise, the end of the day, during late Europe US session, you can close the position. Once the position makes profit of 20-25 pips, keep stop at entry and remove the hedging order so that you eliminate the risk in case if they hit the stop at entry, you don't lose anything, and you will be given a better entry level on, and you can watch for 30 minutes and just enter given slightly lower level, and they are expected to go up. Then during that process you can book profit. So always keep in mind the market continues to give trading opportunity. There is no need to hold a position in a very possessive way that I had taken a buy at 1.23, euro has come down, and come on euro, go up. There is no need to say that. And you have to use the hedging to limit the risk. And simply telling that come on euro, go up, euro is not going to go up that way. No, it is not the horse in the race. And that is gambling. So instead, if you do the trading in a very systematic way, in a professional way, you will only identify what sort of moves they are going to do, what are the triggers during the day we are going to see. Accordingly, you will try to take the positions. So in case the position is hedged, we will watch the market for 30 minutes and see that the hedging is making loss or profit. If the hedging is making loss, we'll cut it with 1 or 2 pips or 5 pips loss and try to keep another hedging order to limit the risk. In case if the hedging is making profit, we will try to maximize the profit by keeping stop at entry in the hedging, and then to closing the hedging with a profit. We will keep another hedging order to limit the risk. When they continue to rise, then we will be able to book profit on the buy side also. As I explained during the European session, if the second time it is hedged, we have to understand that we fail to read that it is an extended move or an intentional move. Instead, we consider it as a stop and so try to identify the move properly, then later on book profit in the hedging. That way you can do either way trading using the hedging. Now with regard to the positions for the European session, since I am carrying the positions from that of the Europe session, I am not adding new positions because there's no point in accumulating positions. That is not going to expand our profit, and the patience and holding the positions calmly and keeping the hedging to limit the risk, and once the position makes profit, keep stop at entry. These are all the strategies going to help us to maximize the profit. So instead of taking, for example, 3 lot positions and trying to book profit in some levels and later on maximize the profit, all the 3 lot positions, instead you can take 1 lot and use the hedging, and you try to do simultaneously that sort of trade in demo trading account. Then you will be able to see either way moves, you will be able to book profit continuously, and very frequently you will be closing all the positions, and always you will protect the open positions. As a result, you will be able to make continuous money on either way moves of the market. And if you experience it in a demo trading platform, you find that is the easiest way of making trades and still earn money, not blowing up the accounts and things like that. You can simply follow it without doing much of a complicated statistical studies, etc. Much of a confusions you can avoid, and simply watch the live market quote page, because the quote page also say the same thing in a very simplified form for us, and you can visually understand what they are trying to do it in the market and try to trade accordingly with patience. So let me just minimize the PowerPoint presentation, and the trades will be as such. I'll just continue to display this particular slide, what I had taken during the European session, because I wanted to show that how when you identify it as an intentional move, you can hold the positions for the third session to book profit. Because simply theoretically telling that intentional move is an upward move for three sessions is not correct. I have to show that this is what happens in the market. I will now focus the camera over the live market code page and take up the questions which are asked here. Okay, Francisco has got a question. A false move is always reversed in the same session. Yes, you are right. False move could be seen during that of the gap time. In less than 30 minutes, they could reverse. And also before the data release and before making the extended move. So normally what they do is before the data release, they make a false move followed by that of the extended move, either on the upside or on the downside, breaching the high or the low. And it may be an intentional move later on if they continue to proceed with the same move. And an intentional move is always confirmed by following two sessions. Yes, always the intentional move is for two sessions and the start of the third session. It may make small swings, it may create uncertainty. And if you always relate it to that of the initial low and the initial high, you'll be able to clearly understand they are trying to do that intentional move. That is why I'm still keeping the open position. Normally, during the tracking the forex market together webinar, I close the positions on the same day and same session and try to take fresh positions during the next session. But today I wanted to show how an intentional move can be identified and how it can be patiently utilized to maximize the profit. Then Gregor. If quick moves are false moves, then USD rise again JPY is a false. No. They are making only small rise. Are they gaining 30 pips, 40 pips quickly in a matter of about 30 minutes? No. 1 pip, 1 pip, 1 pip, they are rising it. 79.44 was the initial high. They just come up to 79.59. 15 pips they are gained. When you look into that of the chart, that is the disadvantage of the chart. Because USD yen is trading around 79.59 to 79.14. So if you look into the chart, it will magnify 1 pip into 1 inch distance. Because hardly the market has shown about 30-40 pips move. So when you find that 2 pips gain will look like a spike. Hardly 2 pips. And it can be just the spread also. But it will give that impression because the visual effect is more important to trigger the emotions. Sometimes, when the rope is there in dark on the floor, when you step on it, if it wriggles, immediately you may think that it is a snake. So it is an assumption or we perceive it wrongly. So in the same way, the visual effect will be when they make a small rise of 3 pips, 5 pips, but when it is magnified in the chart, it will appear as if a big candle has formed. Then you say that it is a quick move. That is why if you look into that of the live market code page, you can understand earlier it was 0.05 pips positive net change during start of my webinar. Now it is 0.10, 5 pip gain they made. Is it a spike or a quick move? They'll loosen. Very logical hedging strategy, but will need some serious practice. Yes, we have to learn all the possibilities of the hedging. After the hedging, if the market goes up, how to handle it. After the hedging, if the market comes down, how to handle it. And they just hedge and go up and you cut the position and then they come down, how to handle it. All you have to understand. so that when you have the ready reckoner systematic procedures, then you will simply implement it without becoming stunned when they are making quick volatile moves in the market. You will do it in a very systematic way. Then you will be able to see that you are really handling the positions nicely and wisely and able to earn irrespective of the market condition. Then Rajesh, in euro, price was above the initial high, and in late European session they were below initial high. No, they made a small dip. That is what? Before the data release time, 12:30 GMT. And high, why is that? In swing, you kept the training, so I cannot give everything, but you can still watch. They'll be able to hold and to go above. Then pipped. Can I have a link to this summary? Yeah, this webinar is being recorded and it will be displayed in FX Street by tomorrow, and also in the blog fxstreet.net. I will display the link so that you can go through that. And any questions you can always ask. I'll display my email ID at the end of this webinar. Okay. Or you located in India? I am located in Chennai, India. Okay, fine. I'll go back to that of the PowerPoint presentation. So these are all the positions now. You can note down the hedging levels, whether they are coming closer to that. And slowly they will be able to swing and gain the levels. You can watch and you can understand how intentional move is. It is a slow move and they continue to make the moves of that nature, and later on, they make the quick move after the FOMC meets on the upside. So that is also a call I have given it. You can just cross check whether it is happening or not. So if you understand how to read the type of moves, you yourself will be able to say, okay, after the data release, that is what they are going to do it. So I'm not more concerned with FOMC minutes. I am more concerned with that of the trigger time. And when they make a false move before the data release, I understand irrespective of the release, they are going to rise the market. So this is how we will be able to read it when you are very close to that particular time frame. So I take this opportunity to thank FX Street for all their efforts to record and display and continue to give education to the traders free of cost. And probably the traders should be able to really make use of it and listen to all the webinars given here, understand various approaches to that of the market, and try to find out which is more suitable for them, and try to develop their own system of understanding the market. Then the fear will go away from that of the mind, because it is really hard to learn, educate yourself and get a degree afterwards going for an employment. Because if you see that certain people go to an employment with a prime objective of completing their education and getting all the qualifications and later on go for an employment. Some people, when they have the diversified mind, they jump from one to another and subsequently they discontinue the education or take only the primary level of education and go to some specializations and things like that. Late come for education and then try to perfect their job. But according to me, trading is an art. So learn it perfectly and then try to enter into the market so that you will not make it as a costly experience of losing so much of money in the market, blowing up the accounts and later on going for an education. But instead it is given free of cost in FX Street and various levels. You try to go through that and understand how the trades are to be perceived. and how you can always uh, take the positions and the market can make an unexpected moves, how to handle such unexpected conditions, how to do the money management, so how to conserve the money and try to maximize the profit on the trades, because without taking position you cannot earn. If you take position, the risk creeps. So you have to balance it and try to act. So those things you have to learn it, then come into that of trading. You'll be able to really enjoy trading and continuously make profits. So this is my website and also my email ID, dr@iknowindices.com, and my MSN Messenger chat and Yahoo Messenger chats I have given it. My telephone numbers I have given it. So any doubt and things like that, if you want to have clarifications, you can contact me. I am willing to help. It is not a business call. I'll help free of cost. So see you again next week during yet another session of Asian Session Live Market Analysis. Thank you one and all.